morning, everyone, and welcome to episode 2 of our Tax Tuesday webinar series. Thanks to KPMG for this great collaboration, Tax Tuesdays. I trust you all still keeping well, staying safe. I think it's great that the handbrake has slowly been released from our economy. But I think as these regulations are relaxed, we can expect a significant spike in cases and deaths as well. So it becomes increasingly important to remember why the lockdown regulations were there in the first place, right? So the regulations are relaxed, but the pandemic certainly hasn't ended. So as we all start getting our businesses going again, I think it becomes increasingly important to make sure that we keep not only ourselves, but our staff and our customers safe as well. Okay, with that public service announcement, the coronavirus pandemic is certainly wreaking havoc with global economies. And I think small to medium business in particular have been hit the hardest. But everyone, from the largest listed entities to the tiniest one-person operation, is trying to improve cash flow at this stage and reduce costs and tax burden and so on. We've seen a number of stimulus packages and initiatives from government, but VAT registered enterprises have received very little, in fact, not much at all, in the form of VAT concessions from government. And it becomes important to really start taking a very close look at that. One of the ways for vendors to maximize cash flow during these challenging times is to ensure that it deducts all of the VAT that it incurs in its enterprise within the ambit of the legislation, of course. So today's webinar is looking at precisely that. It will provide practical guidance for identifying potential cash flow benefits, specifically in the areas where input tax has not been deducted. You're probably wondering, what is input tax? That's certainly top of the list of things we need to deal with today. So today's webinar is going to look at things like what is input tax, what can we deduct as input tax, and when can we deduct it, and also typical areas where vendors do not deduct input tax, and that might be quite interesting and provide some insights into your business as well. We want today's session to be as interactive as possible. Please bear in mind you're more than welcome to ask questions throughout. Please use the chat box or the Q&A functionality. I'll be monitoring those as Martin is doing his presentation today. And we'll certainly try and address as many of those issues as possible. These sessions are recorded, they're available on YouTube, so feel free to go and have a watch afterwards. And as always, please feel free to share your thoughts, future topics, any specific issues you may be struggling with that you'd like us to address, and so on and so on. Okay, so moving swiftly along, today's presenter is certainly very qualified and experienced with respect to that. Martin Delport completed his articles at KPMG and is a qualified chartered accountant. He's got vast experience in the public, mining, retail, and manufacturing sectors, and he specializes in VAT technology, controls, and process management. And his experience in VAT relates to various aspects, including advisory, compliance, and administration. So on that note, I'm certainly looking forward to understanding how we can improve our VAT situation and cash flow. And so on that, over to you, Martin.
Great, thank you very much, Ryan, and good morning, everyone. Thank you for taking the time this morning to share my passion a little bit, and that's value-added tax. I'm going to present my slides, and I trust that you can see that. So the topic for today, input tax in hard-to-reach places. I think it's important to understand that some of these areas that we're going to look at are reasonably technical, but we're going to start off with some easier ones and then the low-hanging fruits, and then we'll get to those more technical ones. Okay, so there's our standard disclaimer. Of course, I'm not going to go through everything in a significant amount of detail. This discussion this morning is just to give everyone a flavor of where input tax sometimes gets lost in the system, and how we can identify transactions where we are under deducting to make sure that we actually, as Ryan mentioned, deducting the correct amount of that. All right, so the agenda this morning, we're going to look at what is input tax. I think that's the critical one in the equation. What is input tax? That's a defined term in the VAT Act. what can I deduct as input tax and when can I deduct it? I mean, those are key questions. Once you've understood what is input tax, what can you deduct as input tax, and then when can you deduct it from a timing perspective? Typical areas, we're going to look at the incorrect system setup in a bit of detail. The incorrect system setup is quite a low-hanging fruit, relatively speaking. And then we're going to look at some of the other transactions where, because of system limitations or the way that the accounting system is set up, or the way processes have been done historically, that input tax is not being deducted. So discount allowed, second-hand goods, bad debts, electronic services applied. We'll look at that very quickly. We've actually had a client recently that have been receiving invoices from a non-resident with South African VAT on, which they haven't deducted. Implications of change in use adjustments. That is quite a technical section, but we'll look at that to see how we can include that. Adjustments made to zero-rated suppliers. We'll touch on that. Supply of going concern, that's obviously quite specific. Self-invoicing, we'll see what is self-invoicing and how we can accelerate an input tax deduction in the case that you are able to apply self-invoicing. And then we'll very quickly look at other. There's always other. And then how do we resolve this? How do we change processes? How do we make sure that in your accounting process, you are actually declaring or claiming the right amount of that? So the first question, what is input tax? So input tax is defined, as I mentioned, in Section 1 of the VAT Act, and it needs to meet these specific criteria. So the first question is, what is input tax? And then input tax is VAT charge on supplies to a vendor. Okay, so very important that the person must be VAT registered that receives that supply, and there must be VAT that's charged. The other one, or the other time that input tax, where something is input tax, is VAT charged on goods imported. So if you're importing stock or capital items that is coming through the border, when those goods clear, there is VAT that's charged on the importation of those goods. Again, I mentioned second-hand goods, where you are acquiring second-hand goods. Second-hand goods is also defined in the VAT Act, but essentially where you are incurring VAT from a non-vendor, you've potentially got a notional input tax deduction that you can look at. And very important is, once you've identified or determined that there is tax that was charged, you can only deduct input tax to the extent, or the VAT that's been charged is only input tax to the extent that those goods or services are required to make taxable supplies. So that is also a key link. So you've incurred VAT, and the question then is, have you incurred that VAT to make taxable supplies? Taxable supplies, again, is also a defined term, but that is where you are making supplies that attract VAT at either the standard rate of VAT or the zero rate of VAT. And as I mentioned here, goods or services acquired only for taxable supplies, you claim full input tax deduction. Where you've incurred that VAT for exempt or non-taxable supplies. So those would be exempt supplies would be financial services, educational, the letting of an abode or a residence rental to a residence. When you incur VAT in respect of those supplies, no input tax is deductible. And then if you are required to apply VAT apportionment in your enterprise, you're only allowed to deduct the VAT to the extent that you're making the taxable supply. So if your ratio is, your apportionment ratio is, say, 70% taxable, you are only permitted to deduct 70% of that VAT on that expense. But the key principle here is essentially direct attribution. You need to decide, okay, has VAT been charged? To what is the purpose of that supply that you received on which you incurred VAT? Is it for taxable purposes? Is it for exempt purposes? or can't you actually make a determination? And in that case, you will apply your portion percentage if that is applicable. And then, of course, the critical part here is you need the documentation. So we'll look at section 16.3, which basically says what you can deduct as tax. But of course, that is subject to the documentation that you need. So when you submit your VAT return and SARS sends you a lovely letter asking for verifications, they will probably ask you for documentation. So that is still very much documentation driven, and you need to make 100% sure that you do have that documentation. All right. So what can I deduct as input tax? So this again is quite important to understand the framework within which input tax is deducted. So 16.3 basically tells you what and when you can deduct it. So a good example is, it's imported, input tax on, normal supplies received, imported goods, as I mentioned, input tax on, credit notes that you've issued. But then again, on top of section 16.3, there are specific deeming sections that we'll look at in a bit of detail going forward, where you could also deduct input tax. So the main point of reference here is section 16.3, which is subject to 16.2 on the documentation side. But again, there's also pieces of legislation scattered through the VAT Act where you also can deduct input tax. So the first protocol, look at 16.3 and see if that supply of yours is going to fall in there. All right, no document, no deduction. All right, typical areas where input tax is lost. So what we see from a VAT perspective on a regular basis, if we look at controls, we look at, do we have sufficient preventative controls to ensure that VAT is not actually lost in the system? Is your coding correct in your ERP system? Do you have sufficient tax codes? Do you have sufficient reviews where you can potentially detect the elements or the transactions where you did not deduct VAT, and how do you fix it? I mean, that's classic auditing days for me there. All right, so preventative, if you look at the ERP system, whether it's SAP, Oracle, ACPAC, JD Edwards, have a look and see how is your tax table, how are your tax tables set up? So if we're only looking at input tax today, do you have sufficient tax codes to enable you to capture transactions in terms of the input tax definition? From an accounts payable perspective, it is very difficult to automate the tax code that attracts, that is attached to a transaction. And the reason for that is not always will you receive valid tax invoices from your supplier. So if you have an account such as stationery, and you're always purchasing stationery from Waltons, for example, it's quite easy to attach a generic VAT code there because you would assume that they are providing you with a valid tax invoice. But then if you are acquiring stationery from offshore or from a non-vendor, you can't attach that tax deductible code because then you'll be overstating your input tax. So your accounts payable side, where all your expenses are going through, is quite difficult to automate, and that's why we also included a point in there to make sure that your staff are trained, that the accounts payable team, they're aware of the transactions, they're aware of the legislation, they're aware of what you need to actually make the input tax deduction in your accounting system. Detective controls we see in a lot of larger systems such as SAP, where the reports that are being provided from that SAP system is not actually sufficient to do a spot check on are you actually deducting all the VAT that you should be including in your VAT return. For example, we see a lot of transactions where there's just a blank tax code. Some clients don't enforce a tax code on a specific transaction. So SAP has got a nice SAP VAT report but that report doesn't include blank tax codes. So immediately, if you go through your trial balance and you look at an account such as stationery, and you draw a general ledger report from that account, you could potentially see a lot of blank tax codes being used, where VAT is being lost. So the whole point of this detective part is to make sure that your manager or senior accountants are actually afforded the possibility to perform a review of the transactions. And then corrective. I mean, once you've identified that there is an issue or there is inconsistent treatment of transactions, how are we going to go about changing that? And I guess also very important, continuous system updates. You know, obviously the VAT rate went up a little while ago, but the legislation also changes. So how often is your system being reviewed from a VAT perspective to ensure that all the updates are actually coming through when you're capturing a transaction? And of course, monitoring the discrepancies. So I know in SAP, you can actually see who posted the journals incorrectly, and then you could potentially monitor that person and not look over their shoulder, but focus on where the opportunities arise. So that's a very high level on the system. So yeah, I've just given some reporting examples that we like to see coming out of a system to provide management with opportunity to actually perform exception reporting and analysis, given the large volume of transactions. And I think the key one that we like to see is the analytics of VAT trends, where you can very quickly see, okay, let's look at accounts payable, let's look at all my suppliers, okay, let's look at, how many different tax codes have I used for this supplier? If I have a supplier of Waltons, okay, now I see there's 5 different tax codes there. There's a tax deductible code, which is great. There's a 0 rated code, which is a bit odd. There's a 14% or 15% output tax code being used for some transactions, which is a bit strange. Or there's just no code that's applied for that specific supplier. So then you need to ask yourself, what is actually happening? But if we take a step back, you have to ask yourself, does my system actually allow me to do the sort of analytics to enable me to identify such exceptions? And that is essentially where the system design becomes critically important when you are implementing, upgrading, reviewing your system to make sure that you are actually accurately recording the transactions. Because it's impossible for a large multinational such as a Pick n Pay or a ShopRite, to go through millions of transactions in a month, or maybe not millions, maybe millions transactions a month, to see exactly what went wrong where. If you do a sample check, you're not going to be able to see all the VAT that is underclaimed or unclaimed. So you need some sort of exception reporting, proper analysis, reporting that's built into your system to allow you that specific visibility. All right, so I've spoken a lot about the system setup and import VAT. So if you are incurring import VAT when you're importing goods in South Africa, that import VAT is deductible if you are a vendor. Remember, it's specifically if you are a vendor. And the timing of that VAT is obviously also quite important. The difficulty with capturing import VAT is that it's not always 15%, and that is due to the valuation of import VAT. So when you bring goods into the country, there's a customs duty value, there's an upliftment, and then there's a VAT that's applied to that value. And because that value is not 15%, the VAT is not 15% of the value, from a systems point of view, it makes it very difficult to automate that. So often it's a manual journal to the VAT control account. And what we've often seen is, given that there is that the goods might not yet have been cleared for home consumption, the goods have been stopped for inspection, and the VAT is sometimes eventually not journalized through or is posted to the incorrect control account. That is often unclaimed. And I think the difficulty here is that, again, you rely on documentation, but the documentation is driven by the customs office. So if your goods are coming into the harbour, for example, they might sit there for a while, especially given the COVID issues, and those goods might only clear, a week, 2 weeks, maybe a few days, or what the case may be. And then your clearing agent might already send you the invoice for the transport costs, but you don't yet have the SCD 500, you don't yet have the clearance notification, and potentially the clearing agent hasn't yet paid the VAT to SARS. So you've already received the supply for the transport service, but you can't yet deduct the import VAT because you don't have the documentation. So then immediately there's a disconnect between those two transactions. So it's very important to have a look and see how you can manage that. Clearing agents legally are required to provide you with the supporting documentation. That is 100% correct. And here we obviously also recommend a very good relationship with your clearing agent. So making use of reputable clearing agents where we've got a good relationship to make sure that you are actually getting the documentation within a reasonable amount of time, to make sure that the VAT that you are paying the clearing agent, you can actually deduct very soon after their invoice is provided. All right. So discount allowed. This is actually one that we do see quite often, and that is where the supplier is accounting for the discount allowed based on the remittance advice you receive. So what we often see is a supplier will issue 20 or 30 invoices in a month, and the recipient will make a bulk payment at the end of the following month, for example, with the remittance advice that says, okay, I'm paying these and these and these invoices. And then, they just say, okay, well, less the volume discount or settlement discount, and we're only paying this amount, which is obviously a reduced amount. But now the supplying vendor, what we have often seen is they just journalize that full discount allowed to that expense account, discount allowed, and they don't take out the portion that relates to the VAT, to the VAT control account. And often the reason, I guess, for that is they don't have the documentation to make that input tax deduction for the discount allowed. So technically it is correct what they're doing because they're not claiming the VAT. But technically they are required to issue a credit note where the VAT was altered. And then upon the issuing of the credit note, the supplying vendor will be able to make a deduction of the VAT. I mentioned here the inconsistent treatment in discount allowed. So now remember, discount allowed is sitting as an expense in your trial balance, and you could either decide to reduce your sales or reduce your output tax by the discount that you've allowed, or you can increase your input tax. And if there is an inconsistent treatment, there'll be quite a big RT14 SD reconciliation difference, because your gross sales that you use when you do your RT14 SD might not have been reduced by the credit notes. Just keep that in mind. In respect of prompt settlement discount, so if there is no payment on remittance, for example, the prompt settlement discount, if it is stated on the invoice, the credit note is not required to deduct the input tax on any settlement, because then you'll just present the invoice and proof of payment for that deduction. But if it's not on the tax invoice, you still need a credit note. Again, documentation. Second-hand goods, I'm going to go through this very quickly. A VAT 264 is required when you actually acquire goods from a non-vendor and you would like to make a deduction of second-hand goods. A good example of this is when you sell your car to a car dealer, because he's a dealer, he can deduct the VAT on the motor car. Obviously, you know, a normal vendor can't make deduction on motor cars. But when you sell your vehicle or you trade it in, the Toyota will issue with a VAT 264 in respect of that motor vehicle, and that will enable them to deduct the VAT. So if you are acquiring second-hand goods, make sure that you do complete the VAT 264 and have this the non-vendor actually sign the document. So generally in enterprises, we don't see a lot of this happening because these will generally be low value. But if you've got high volume of these, then obviously that would make a difference. Bad debts. So in this case, in this environment, you might see a lot of bad debts. Again, if you are incurring, I don't know if it's incurring, if you're unfortunate enough to have bad debts, an input tax deduction is permitted, provided that one, it was a taxable supply, two, it was a standard rated supply. I think that's also pretty cool. And you know, the amount or part thereof becomes irrecoverable. So the VAT fraction of the amount written off is then an input tax deduction, and when it's recovered again, it's an output. Special rules for installment credit agreement, provided that you know the goods are not repossessed or surrendered. And then there are also special rules for debtors that are transferred or acquired on a recourse and non-recourse basis. So if you have a book debt that you're selling to someone at a discount and reacquire later and write it off, you know, there's special rules around that. So as I mentioned right at the start, there are a lot of special rules, exceptions, provisos in the legislation, but this just gives us a flavor of where you could potentially start looking for that is not captured. And we often see from a systems point of view that the tax code is often not applied to bad debts, and then the full amount sits in your trial balance under the bad debts expense account. Also, just remember provision. There's no VAT on a provision. All right, electronic services, as I mentioned earlier, electronic service legislation applicable since the 1st of June 2014, and a lot of foreign suppliers have been charging South African VAT, actually. Very important, if you are receiving invoices from a non-vendor with South African VAT or perceived South African VAT, just have a look at the SARS website. They've got a very nice VAT vendor search, and you can actually type in the VAT number and you can validate the vendor on that basis. Very important to ensure that you are receiving a valid tax invoice from the non-resident electronic services supplier, because what we've often seen is their systems actually cannot comply with these binding general rulings, and that makes it difficult for the recipient to actually make that input tax deduction. So just be aware of that. Change in use adjustments. So this is quite a technical section. This actually sits in section 18 of the VAT Act, so outside of section 16. And section 18 deals with the changes that you have, the changes in the application of the assets. So remember, when we looked at the definition of input tax, we looked at what is the purpose. The purpose is to use or supply or consume it to make taxable supplies, in which case you could deduct the VAT. But now, potentially you've either introduced those assets or those goods or services to make taxable supplies, or the use has changed in terms of an apportion percentage, for example. So an example that I've given here is the introduction of goods or service for taxable use. We actually have many clients that we assist with VAT registration, and they have incurred a lot of expenses before the VAT registration. A lot of those are assets, you know, capital goods or capital services, and now they're registered, and now they're asking, okay, well, can I deduct the VAT on those supplies that are received prior to VAT registration. So because you've introduced those goods or services into your business, into your taxable business, the purpose and the use, the application of those assets have not changed from being non-taxable because you were not registered when you acquired it, so you couldn't have acquired it for taxable purposes at the time. But now you're introducing those assets into your business, and then you can obviously make an input tax deduction. There's special value rules also that you'll need to look at, and of course supporting documentation. Another example, a restructure of operations. This we often see in entities such as banks or financial institutions, where you've got a reclassification of a business unit from being mixed or exempt to a taxable. So treasury function, the treasury function was completely exempt. No VAT was claimed in that function because it made exempt supplies. Now some of those computers or that treasury function is now also performing taxable services. So now those are becoming mixed. So now those goods are actually being introduced for taxable use. So just be aware if your business is going through restructure where you've had some VAT that's partially claimed, take that into consideration. And of course, input tax on an asset that was never deducted. So if you acquired an asset, even while you were VAT registered, you never deduct the VAT, then you can go for it. But again, important to look at the documentation. I mentioned the increase in taxable goods or services. VAT apportionment adjustments. This is also quite specific for certain industries where your apportionment adjustment has changed by more than 10%, and going a favorable way where you are becoming more taxable by 10%. Remember, you can make the deduction in respect of the increase of taxable use in respect of those assets. And again, there are specific formulas. Section 18 also deals with the case where assets are exiting your enterprise or the taxable use is reduced, where you actually need to make an output tax adjustment. But in this case, we're obviously also only looking at input tax. Yes, important. The value rules in terms of the formula makes reference to the open market value. So interesting is capital goods is relatively easy. So if you've got stock or property, plant and equipment, PPE, not the protective equipment, personal protective equipment, and capital services. So I sometimes find it difficult to understand, okay, what is a capital service to the extent that you've capitalized it to your balance sheet, because remember, you need to determine the open market value. So if you've paid rental, for example, and that rental is sitting as an expense, that won't have an open market value, say 3 months down the line. So very important that there needs to be an open market value in respect of those capital goods and, well, goods and services to enable you to make that deduction. And for the documentation, have a look at interpretation note 92 on that. Adjustment to zero-rated supplies. I'm not going to go through this in a lot of detail. This is essentially where you apply the zero rate. You could not comply with the documentation to support the zero rate, and you were required to make an output tax adjustment. But then you acquired the documentation, say, a number of years later. As long as you receive the documentation within a period of 5 years, you are permitted to reverse that adjustment. But what we've often seen is the adjustment is made, say in 2018, down the line, the documents keep trickling in. And then at some point, all of a sudden you've got the documentation, but you never actually made the reversal. So that is quite a relatively easy place to go and look to see if you are actually entitled to reverse that output tax that you initially declared on the zero-rated sale. In respect of goods, zero-rated goods, again, work closely with the clearing agents to ensure that you have the documentation in respect of can make the deduction, because trying to keep track of all the different types of documentation, especially if you're looking at an indirect export of goods by road, the documentation required is extensive. So it's very important that there are processes in place to ensure that the documentation is easy to obtain and manage. Supply of a going concern, this will also only be relevant where you've got a business that is partially taxable. So if you are a business, a bank, for example, and your bank is 60% taxable and 40% exempt, selling a commercial building that's 60% taxable, 40% exempt, and you're selling that you're selling that enterprise as a going concern, to the extent that that enterprise made mixed supplies of VAT was partially deducted, that VAT can now be deducted in terms of section 16(3)(h). That is a very specific section of the VAT Act, and that links in with section 18A. So remember, even though you are permitted as a supplying vendor, supplying the going concern, to make that adjustment, the person on the other side, the recipient of that enterprise, is required to make an after tax adjustment in terms of section 18A in respect of that exempt, that partial portion. All right, self-invoicing. This is a very specific section, and there's been a number of rulings of interpretations. You'll see at the top there the relevant sections to look at. But the reason why, I'm just going to play this whole slide. The reason why this is a nice section is this could essentially accelerate your input tax deduction, where you make use of maybe when you make use of agents in your business to sell goods or services on your behalf. So very important that the conditions for self-invoicing is met, and the conditions are that the recipient of that service controls the quantity and quality of supply. Okay, so a good example of this is, say, in the agricultural industry, where a farmer or a person brings fruit to the farmer, and the farmer weighs and determines the quality of the supply, and then essentially, without waiting for the person to actually invoice the farmer for those goods, the farmer actually invoices himself, because he is in control of the quantity and quality of the supply. Another example in the financial services industry is where you've got a broker that's selling goods on behalf of the institution, selling services on behalf of the policies, for example, and only the financial institution actually knows what the quantity or quality of that supply is in respect of that service. So instead of waiting for the broker to invoice the financial institution will actually invoice itself. So that could essentially accelerate the input tax deduction. And then there's also a number of other requirements. But the critical thing is, can you actually comply with the main feature, which is that the recipient determines the consideration and controls the quantity or quality of the supply. If not, then you'll need a specific ruling from SARS. So this is not always going to be applicable, but it's always worthwhile thinking about and whether it could potentially be applicable in your system. Other items, so SARS assessment reducing a refund. So we have often seen clients receiving assessments, but essentially reducing their refund. So in terms of the VAT return, there's R1 million refund, but they only get refunded 800,000. So then, there's no penalties and interest, so it just reduces the refund. And the client doesn't necessarily monitor its statement of account or e-filing profile, and doesn't look at this or doesn't see the assessment, and then that VAT gets lost. And we've actually often seen clients coming to us and asking us was, can we go back, 5-6 years to try and get this money back in respect of the SARS assessment. So word of advice there, have a look at your statement of account, have a look and see where your refunds haven't been fully settled by SARS, where they've made an assessment, reducing the refund, because you might not actually see it. And also important to keep your details up to date with SARS. Another one that's quite easy is subsistence expenditure. Again, I guess in this day and age, not a lot of people are traveling. So it could be the perfect time to actually start setting up processes and procedures for when we are able to travel in the future. The main consideration here is it actually subsistence expenditure? Because we know entertainment is not deductible for VAT, but where you are in terms of your employment, required to spend one night or more away from your usual place of work and residence, you're actually permitted to make an input tax deduction in respect of those expenses. A lot of clients say, well, the value of the VAT they incur is not significant enough to, justify significant, processes and, procedures and expense claim systems and things like that. But I mean, it depends. I mean, have a look at your trial balance and see, well, how much expenses are actually going through your books to see, well, if you're not claiming it, then you should potentially consider looking at attribution of expenses. This quite a detailed assessment that usually is done on an annual basis for entities that apply VAT apportionment, such as your financial institutions, to determine, okay, well, can they potentially reclassify business units or expenses to make taxable supplies, or look at the actual activities in the business to see, well, can't we actually attribute more expenses to taxable purposes? And then lastly, time value of money considerations. There is a section in the VAT Act relating to interest on delayed refunds. So if you have a refund outstanding, follow up on that. See, when has that been outstanding? Make sure the ball is not in your court. Make sure that you actually have sent SARS all the documentation that they need. Phone them, record the case reference number, and then build up a little case of evidence to make sure that if you are going to submit a letter supporting request for interest, that you actually are able to support that with hard facts and evidence. This VAT deduction between accounting month-end close and actual month-end close, this is administratively difficult to achieve in the long run, or to maintain in the long run. Easy to achieve in month one, and you get essentially a VAT acceleration in the first month. So essentially what this what this means is a normal business will close, say, on the last Friday of a month, but then there are maybe 4 or 5, 3, 4 extra days in that month that is not part of the said month. So what happens then is there's a manual process that includes those 4 days into the said month, and includes those in that month's VAT return that you submit in the following month. So essentially you're taking your month end, adding the few days that, in terms of the calendar days, fall outside your month, but still within the month of, say, May. You're going to submit your May return now in June. And what you're going to have to do in June then, when you do your June return, is actually exclude the additional transactions that you included in the May return. So it gives you an acceleration for 1 month, but then to keep track of it indefinitely becomes administratively difficult, but that is a possibility. Ensuring the VAT return support is readily available. So this is very important. When you submit your VAT return and you have a refund due, you must have a look at your e-filing profile and see, has SARS actually issued a verification letter? If they have issued a verification letter, or even before that, once you've submitted your VAT return, you must make sure that you have all the support ready for, not if, when SARS sends you a letter for verification, so that there's no time scrambling to look for invoices, to look for schedules, that sort of thing. So everything must be ducks in a row, so that as soon as SARS issues that letter, you can submit the supporting documentation. And we've actually had some cases for our compliance clients that the verification is closed on the same day that the verification letter was issued, and the refund paid out a few days later. Agency principles, this is also very specific. I am just conscious of time. Don't want to go through this in too much detail, but if you are acting as an agent for a non-resident that is not a vendor, and the supplies that you receive relate to foreign-going ship, foreign-going aircraft, there are cases where those supplies are actually deemed to be made to the agent. Okay, so that would mean that the agent can actually make that input tax deduction, even though the supplier that's say that, for example, supplied not fuel, because that's zero rated, but say some sort of service to the non-resident principal, and there's VAT on that service, the agent acting in the middle can actually make that input tax deduction. So if you're acting in that sort of industry where you deal with foreign agents, foreign going ships, foreign going aircraft, have a look and see if there's potentially a VAT deduction sitting there. Time lag between invoice date and capture date. We see this a lot. When we do analytics on clients' accounts payable system, we see posting date and invoice date, sometimes 3 months, 4 months difference between the two. So important to try and get that capture date as close as possible to the invoice date to save that bit of interest. And then don't account for VAT where you are not making a taxable supply. Sometimes we do actually see this. For example, if you've acquired goods that an input tax deduction was not permitted, so you acquired a motor car and you could not deduct the VAT, and then you sell the motor car, that is not now all of a sudden a taxable supply. So if you are making supplies, make sure that you actually have to account for VAT on that supply, because we have seen cases. Okay, so how do we resolve these? How do we resolve these issues? First of all, staff training, critical. Make sure everyone's on the same page. Make sure that if there's someone new joining, make sure that they understand what the processes are, what the codes are, what the transactions are that they'll be dealing with, because sometimes, certain teams are so large that they only deal with certain suppliers. So make sure that they know exactly. Let's go back to the drawing board. VAT policies and manuals, critical. If we're looking at succession planning, maybe that's a bit extreme, but if we're looking at, if someone leaves with all that institutional knowledge, they're taking all of that with them, what sort of handover are they doing? Are they actually handing everything over? How do we know that the new person that has joined actually knows everything? I guess that also links in with staff training. When legislation changes, is everyone aware of, new interpretation notes or new binding general rulings on, what is accepted? Communication. I think that is also, within an organization between the different departments. Procurement versus accounting is just, one example. We're looking at logistics. I spoke about imports and exports. Make sure those departments are talking to each other in respect of, getting the documentation, understanding the nature of the supplies that are being received. Specialist review, of course, in respect of specific transactions where you are, maybe unsure, or if it's a new transaction, for example, definitely worthwhile to get a tax practitioner involved in, making sure that you're treating it correctly. It might be a high value transaction, which makes even a more reason to contact the tax practitioner. But also if it's a high volume, if there's going to be a lot of these transactions going forward, it's worthwhile getting input and then putting controls in place to make sure that going forward indefinitely that transaction will be treated correctly. And then, as I mentioned right at the start, appropriate tax reporting. I think that above a lot of things is going to be very, very important in designing your system, maintaining it, and allow for accurate reporting and analysis by the tax team. All right, I think that was a very, very helicopter view of potential VAT deductions that we see in practice being missed. But I would now like to open the floor for questions, or Brian, if you've got some questions there on that side.
Thanks, Martin. Yeah, that certainly was an incredibly detailed and technical presentation. Thank you very much for that. I just want to apologize very quickly to the audience. We did have some issues with your sound, Martin, or some attendees struggled with your sound a little bit, but I think just for anyone that may have missed anything, this will be available on the ACT website and our YouTube channel, so please feel free to go over there. And of course, if I've learned one thing today, or I would say the most important thing I've learned from your presentation, it's the importance of consulting experts and having someone like Martin casting an expert eye over your affairs. So please feel free to reach out to Martin directly as well, and his details will be made available. Okay, so we've got a couple of minutes for questions. The first one that's come through, Martin, from Regina Masson. So they had an agricultural entity, 98% zero-rated supplies. And the question is, can it only claim 2% of input VAT supplies, the input VAT arising due to overheads?
Yes, I think very important to understand that a zero-rated supply is still a taxable supply. So if you are making taxable supplies 98%, then definitely your input VAT arising from your overheads are fully deductible. Also, if your apportionment ratio, so if you were making 98% exempt supplies, then you won't be able to claim any VAT, because then you won't be able to your apportionment ratio would be significant. But if you're making 98% zero-rated supplies, then definitely deduct the VAT on the overheads. Because I guess also your agricultural supplies would fall into the schedule in the VAT Act that zero rates all the supplies of agricultural goods or pastoral, fertilizer and things like that. Great.
Martin. And then just a slightly different one. I know there's been an issue with VAT refunds previously from SARS and the timing of VAT refunds and so on. And these were meant to be fast-tracked under CV19, but we know we have a government that promises a lot and sometimes isn't quite as efficient in delivering. Is there anything perhaps that you could note from your experience with respect to the timing and the cycle of these VAT refunds?
Yes, I mean, from a VAT refund perspective, as I mentioned briefly in my presentation, it is critical to understand where you are sitting in the process, because if your VAT return went in, there's a refund. Have you received the verification letter? If you've received a verification letter, have you responded to that letter? If you've responded to that letter, how many days have passed since you've followed up or since you've sent the information? It is in practice, it is usually quite tricky to coordinate an approach to SARS where you're actually not sure where in the process you are, and contacting the call center and getting a case reference number, even though you might think practically that doesn't really have any impact, it definitely has an impact. When it starts getting to an objection, when it starts getting to appeal, when it starts going to the tax court, ADR, you definitely want some a case of facts and evidence that you can take forward in the event that you do need to follow that process. So when you submit your VAT return and you have a refund, make sure everything's there. Make sure you've got a little bucky with the top 5, top 10 invoices, input output schedules, maybe even a cover letter. We usually, if there's a significant input tax or a refund due, we will draft a cover letter explaining why there's such a big refund. But something that we have actually seen in respect of our April, I'm just saying June now, our April returns that went in for some of our clients, they have actually not been assessed by SARS. So as we know, that is a self-assessment tax. So you submit the return, but the return on e-filing was actually rejected by SARS. And we had to call the call center because, there were no documentation issued on the e-filing profile. And they mentioned that they tried to contact the public officer to try and understand, why, even before a verification letter was issued, nearly upon submission of the return, there was an involvement from SARS and asked, okay, what is going on here? Let us contact the public officer. Couldn't get hold of the public officer, return got rejected. So again, having those details updated with SARS, understanding where you are in the process, contacting the call center, all of those things definitely adds weight to where you get to a point where things actually start becoming unbearable and you need to actually take some dispute resolution courses of action. Sorry, Ryan, I think you're on mute there.
Sorry, schoolboy error. No, I was saying thank you very much, Martin. I think those are the last of the questions. And again, bang on time, so fantastic timing. So I think all that's left to do is to close out. Just to note, there were another couple of questions around the slides being available, and just to confirm that we will definitely make those available, both on the website as well as this entire webinar on the YouTube channel. So please feel free to check those out. And then also Martin's details will be included in all of those. So again, I highly recommended, I think, to reach out to someone who is skilled in this, just to cast an expert eye over your affairs. I think that would be definitely money well spent. So on that note, Martin, thank you very much for your insights today. Massive thanks to KPMG as well for your support of the series. And of course, to all the attendees. We had a really nice audience today. So thank you all for hanging around and for being part of this and for your interaction and engagement. We look forward to hosting you at the next one, the next Tax Tuesday with KPMG coming up. If not next week, then the following week. But please remember to check in with the Accelerate website, as we'll be doing all kinds of webinars going forward. On that note, keep safe, keep well, and we look forward to hosting you at the next one.